Welcome to all. I'm Dr. V. Srinivas, Assistant Professor, Department of Commerce, maybe Siddhartha College of Arts and Science, Vijayawada. Today's my topic is ratio analysis. Financial statements, profit and loss account and balance sheet prepared at the end of the year do not always convey the real profitability and financial health of the business. Financial analysis is the process of using financial information to assist in investment and financial decision making. Financial analysis helps managers with efficiency analysis and identification of problem areas in the firm. Also, it helps managers identify strengths on which the firm should bid. Externally, financial analysis is useful for credit managers evaluating loans, requests, and investors considering security fees. Ratio analysis is the most important tool for analyzing this financial statement. It is used as a device to analyze and interpret the financial health of enterprise. Ratio analysis stands for the process of determining and presenting the relationship of items, group of items, in the financial statements. It is an important technique of the financial analysis. It is a way by which financial stability and health of the concern can be judged. Ratio analysis helps to gain a deeper insight into the financial health and this current and probable performance of the company being studied. For this insight, this analysts use the quantitative methods where this information recorded in the company's financial statements are compared and analyzed. A financial ratio is the relationship between two accounting figures expressed mathematically. Meaning of a ratio. A ratio is a mathematical number, mathematical expression calculated as in a reference to relationship of two or more number of numbers and can be expressed as a fraction, proportion, percentage, or a number of times. When the number is calculated by referring to two accounting numbers derived from the financial statement, it is called as an accounting ratio. So accounting ratio establishes a relationship between this two balance sheet items or profit and loss account items or between profit and loss account and balance sheet items. That is an accounting ratio. It needs to be observed that accounting ratios exhibit relationship any between these accounting numbers extracted from the financial statements. Ratios are essentially derived numbers and their efficiency depends a great deal upon the basic numbers from which they are calculated. To know objectives of ratio analysis, to know the areas of this business which need more attention, to know about the potential areas which can be improved with the support in the desired direction, to provide a deeper analysis of the profitability, liquidity, solvency, and efficiency levels in the business, to provide information for making cross-sectional analysis by comparing the performance with the best industry standards, and to provide information derived from the financial statements useful for making projections and estimates for the future. Significance helps in analysis of financial statements. Ratio analysis is an extremely helpful device for analyzing the financial statements. It helps the bankers, creditors, investors, shareholders in acquiring enough knowledge about the profitability and financial health of the business. Simplification of data. Sometimes it's very difficult. A layman cannot understand this balance sheet figures or profit and loss account. But this with a simple arithmetical expression, even a layman can understand this data. Accounting ratio simplifies and summarizes a long array of accounting data and makes them very easily understandable. Helpful in identifying the weaknesses of the business. Current year's ratios are compared with those of the previous years, and if some weaknesses are thus located, remedial measures can be taken to correct them. Helpful in forecasting. Accounting ratios very helpful in forecasting and the future plans. Estimate the trends of the business. If accounting ratios are prepared for a number of years, based on this, let's reveal the trends of the cost, sales, profit, and other important factors. Fixation of ideal standards. Ratios helps us in establishing ideal standards for different items of the business. By comparing the actual ratios calculated at the end of the year with the ideal ratios, the efficiency of the business can be easily measured. These some limitations of the ratio analysis. False accounting data gives a wrong picture. Lack of adequate standards, limited use of a single ratio, a change of accounting practices, procedures and practices, window dressing, ignores price level changes, ratios alone are not adequate for proper conclusion, ignore qualitative, non-monetary aspects. Classification of traditional classification and functional classification. These are the traditional ratios, profit and loss account ratios, balance sheet ratios, composite ratios. Functional ratios, liquidity ratios, or short-term solvency ratios, leverage long-term solvency ratios, activity ratios are also called efficiency ratios, profitability ratios. Liquidity ratios measure the ability of a firm or company to repay its short-term debts and meet unexpected cash needs. Liquidity ratios measure the firm's ability to meet its maturing financial obligation, short-term obligation. The current ratio is the most common liquid measure and provides an indication of a firm's ability to pay short-term claims with short-term assets, important liquid ratios or current ratio, quick ratio. Current ratio is a ratio between its current assets and current liabilities and establish a relation for a particular period. This ratio establishes a relationship between current assets and current liabilities. The objective of computing this is to measure the ability of a firm to meet its short-term liability. Current ratio is current assets by current liabilities. The ideal ratio is 2:1. Current assets, which can be easily converted into cash within one accounting year. A current liability is an obligation that is payable within one accounting year. These are the components of current assets and current liabilities: cash, bank, stock, debtor, bills receivables, marketable securities, prepaid. These are all components of current assets: creditors, bills payable, bank overdraft, accrued expenses, other short-term obligations, current liabilities. Significance: it indicates the amount of current assets available for repayment of the current liabilities. Higher the ratio, higher the short-term solvency of a position, and vice versa. The ideal ratio is 2:1. The quick ratio is a more conservative version of another well-known liquid metric. The quick ratio provides a more rigorous assessment of a company's ability to pay its current liabilities. Quick ratio is quick assets by current liabilities. 1:1 is considered good for the company. It measures the instant debt-paying capacity of a business enterprise. Solvency ratios, long-term solvency. A company usually does not only run at 1:1. Most companies have a debt factor such as long-term loans, deposits, dependents. The term solvency refers to the ability of a firm to meet its long-term obligations. So a check has to be kept on this cost of such debt, whether the company is capable of meeting such costs. Solvency ratios are useful to analyze a firm's ability to meet the fixed interest charges and repayment capacity of long-term borrowings. Solvency ratios are the ratios which are calculated to judge the financial position of the organization from a long-term solvency point of view. These ratios measure the firm's ability to satisfy its long-term obligations and are closely tracked by the investors to understand and appreciate the ability of the business to meet long-term liabilities and help them in decision making for long-term investment of their funds in the business. Debt equity ratio, long-term debt by shareholders' funds, interest coverage ratio, net profit before interest and tax by fixed interest charges. Activity ratios, efficiency ratios, sometimes called as asset management ratios, measure the efficiency with which a firm manages its assets. Inventory turnover ratio or stock turnover ratio indicates the relationship between the cost of goods sold and average inventory. Inventory turnover ratio measures how fast a company sells inventory. Low turnover simply implies weak sales and possibly excess inventory, also known as overstocking. Stock turnover